their bookkeeping might be a mess, their operation might be a mess. That's opportunity for guys like you and myself and other people that can come in there and effectively operate that and capitalize on running it more efficiently.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with a good friend of mine, Zach Hoereth, who's an investor living down in Florida, but who primarily focuses in the Midwest, throughout Indiana and some tertiary markets throughout the state of Indiana. And we have very similar stories as it relates to how we've grown our businesses. Zach has focused on direct to sellers since he got into the business, and he's done a lot of small to mid-size multifamily deals along the way. And in this episode, we chat about how he's finding deals now as it relates to what he's actually doing from a marketing standpoint, speaking with sellers, the power of follow-up. And we also share some fun stories as well around some of the deals that he's been doing. And the last time Zach was on the podcast, I believe I made the title Buying Properties for $1. And a lot of people obviously listen to that episode because it's a pretty enticing title. And in this episode, we touch on that, and we touch on some other funny stories as it relates to going direct to seller and what you really need to accept from a risk standpoint and an availability of diligence standpoint if you're going to go this road in your business or down this road in your business. So if direct to seller is not something you're presently doing, but you want to start marketing directly to owners, this is going to be a great episode for you. And Zach and I have just known each other a long time, and this is a very friendly conversation. So I think it'll be an enjoyable listen for everybody. That said, Zach he recorded this while he was out at an Airbnb in Scottsdale, so audio quality could be a little bit better, and his internet cuts out a couple times throughout. We've done our best to edit the episode and actually splice those challenging periods together. It's not going to hurt the content in the episode at all, and I don't want to deter you from listening to it. But just a heads up in case you hear any kind of jumps in audio or like breaks in thought, that's us doing what we can on the editing side to put this episode together as best we can. So just a little disclaimer there before we get into it. But by all means, listen to this episode if direct to seller is something you're doing in your business or that you want to start doing. And again, this is just a great friendly conversation with a good friend of mine. So without further ado, let's get to this episode with Zach Hoereth. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me is a friend of mine, someone who's been on the podcast, I think twice before. I think this might be number 3 here. But Zach Hoereth is with me, who's currently doing this at 6:30 a.m. In Scottsdale. We're dealing with a time difference. He looks alert, but I'm going to wake him up with this podcast. So Zach, why don't you give everybody a little intro, though, in terms of who you are? And, obviously, I think I'll link to the previous episodes here in the show notes, but the spark notes on where you're from, what you got going on,
Sure.
and how you found the real estate game.
Well, first and foremost, thank you. I appreciate you having me on. Kind of pushing some of the dust and crust out of my eyes out here. But no, I mean, I've not lived in Indianapolis for 4 or 5 years, but born and raised in the Midwest. Originally, got into real estate off of a kind of one-off single family flip, and started off as more of a agent, trying to find my way, figure out what the hell was going on. That snowballed into, purchase a few single family homes. Fast forward today, primarily, buying small commercial, got a handful of small apartment buildings and some self-storage, and a number of single family homes. So have run it kind of like a pretty small, almost like I would describe it like maybe a small family office without a ton of money. And that's what I'm working on still today. So like I said, heavily focused on the Midwest. I do live down in Florida. So most of the deals I'm doing are remote. But yeah, that's my core focus today. And I've had the pleasure of some different, partnerships in numerous states, and trying to find my way, just like I guess any investor would. But yeah, been very, very fortunate. So
Mm-hmm. Yeah, absolutely. I mean, small family office just with less money that's perfect. That's like a LinkedIn like profile tagline. Family office, CEO of whatever family office, and then you go into their bio and
Sure.
it's like, all right, well, we're working with not a lot of money here, but I like that. That's good.
It's either that or tell people I'm a realtor. So it's
Yeah, yeah.
one spectrum, one end of the spectrum or the
I was gonna say, talking about the
other.
pendulum swinging all the way to the other side from realtor to small family office. That's good. But yeah, and then for the listeners too, like as I said,
Sure.
I'll link to the previous episodes. But what we're going to talk about in this episode, Zach's bought a lot of property direct to seller, a lot of
Correct.
small to kind of mid-size multifamily, as well as some of the commercial stuff that he's talked about, which is obviously what I primarily do, just in a different market. But there's a lot of overlap in, I think, how we approach the business, which is obviously what I want to get into now. But real quick, I mean, you mentioned you're doing deals in the Midwest. But I know you've lived in Florida now for a couple of years or a few years. I mean, it's
Yep.
been a while. I mean,
Yep.
you were down in, I think it was like what, Fort Myers, right, for a little bit, and now you're up in Tampa.
Yep.
Is that just
Yep.
personal, or are you looking to do any deals there? Looking for deals in that neck of the woods, or solely
You know,
focused on the Midwest?
originally when I spent some time in Fort Myers. Actually, I went to school there for a year when I was on my three school tour. So I was familiar, and when COVID hit, I didn't end up graduating from that school down there, but I always enjoyed. And I know you can probably respect this as a Northeast guy. I always enjoyed the winters down there because man, in the Midwest it gets pretty cold. And so I always told myself, hey, when I have the opportunity to be able to get back down here, that's what I want to do. So I had the opportunity to get a place down there during COVID, and yes, that was. I started kind of poking around, looking for some opportunity, small multifamily. Did a few rounds of mailers and kind of my marketing scheme down there, if you will, and really had a tough time. The I felt like the barriers to entry were a little bit higher than most of the like tertiary markets that I play in the Midwest, and so I just didn't have a lot of success. And kind of quickly realized that wasn't something that I wanted to. Felt like I was really fighting an uphill battle trying to break into that market in Southwest Florida. I think at the time, interest rates were still pretty low. Things were trading at, just disgustingly low cap rates, and that's what kind of pushed me away from it. So
Hmm.
I looked at it as, hey, I need to double down on what I'm doing in the Midwest, and if I want to live in Florida or wherever that might be, that's just more so personal. So yeah, anymore, no, I don't. Like, even up in Tampa, I'm strictly there just to enjoy the lifestyle and not really looking at deals. It's interesting when you go to these meetups or you're talking to people and they kind of look at you like you have three heads when you're like, yeah, I'm not really interested in investing here. I feel like I'm pretty niche down into where I'm at. And that's just my
Yeah, and
strategy
it's
right now.
easier, right? It's just easier to
Correct.
keep pouring
Correct.
gas on what's
Correct.
already a pretty big fire.
Correct. Yeah.
I will, one follow up though, as it relates to Florida and looking down there, for deals, I should say. Uh, I think it was on Twitter or somewhere like, and maybe you saw this as well because you're also on, pretty active on Twitter, but there was somebody like circled like the stretch from like north of Clearwater down, pretty far south, and maybe down by
Yeah.
St. Petersburg or all the way down to like, kind of Southwest Florida down to the Fort Myers area. And then there was some stat where it was like, there's the same amount of listings here that contain the word distressed as like the entire state of California. And basically the point of the tweet was, a lot of people are looking to sell here. There's a lot of listings. People are looking to get out of this, and it's probably for any number of reasons, whether it's insurance going nuts, and people
Sure.
just not really understanding what they were getting into on that front. There was just obviously there was an extremely hot market that's probably rebounding a little bit
Yep.
more aggressively here. Um, Maybe a lot of people bought short-term rentals, and now that market's kind of dried up, or legislation's changed, whatever it is. There's
Sure.
probably a whole number of reasons, but in terms of the classic definition of like seller distress, I would, just speaking incredibly broadly, there's less distress in the Midwest or the Northeast or the West Coast, primarily because they didn't have the same level of buyer interest over the last 5 years as like a
True.
lot of the big cities in Florida or the big
Yep.
cities in Texas or the big cities in Arizona. Um, and probably more folks that meet that definition of distress. Maybe they paid too much. Maybe they have a little too much debt. Maybe they misunderwrote because of the insurance dynamic or what have you. Does that call your attention at all in terms of like this? there's some classic signifiers of distress down here that maybe isn't as relevant, or I shouldn't say relevant, as prevalent in the Midwest? Or are you still just like, you know what, I got a good thing going. I really don't even want to change my focus because this is something I
Yeah.
struggle with. Yeah.
Uh, I mean, it was, you know, I hate to say like, I have, I guess I'd put it this way. Like for me, I've done a lot of deals in the Midwest at almost to the point, especially on very small stuff, you get to almost in a flow, right? We're like, oh my gosh, I feel like we have so much organic inbound. Um, you're getting a lot of traction. You almost feel like, man, I could do this in my sleep, right?
Yeah.
It's a little bit tougher when you try to enter into a new market, and it is very competitive. There's some other obstacles that you have to run into, i.e., insurance. I don't think a lot of people know this, but Fort Myers got annihilated by the hurricane,
Yeah.
and so like my parents had moved down there. I'd had a place down there. My grandparents had moved down there, and the media didn't really report all that much. I think like the severity of that hurricane, and a lot of folks really got into a bad position with their insurance. Right, it wasn't so much, hey, they didn't have whatever the hurricane insurance, but more so flood. It was the storm surge that came through and just really got a lot of people in trouble. So folks that didn't have that insurance coverage, maybe they own their home free and clear, and that was kind of like their only really asset. Those people have nothing now, right? And so when I think about that on the commercial side of things, or just in my own, as I build out the portfolio, those are just items that I'm like, hey, I don't want to run that risk of putting my money at jeopardy, other people's money in jeopardy. Again, those are just items that, like a hurricane, like a major natural disaster like that, there's a lower likelihood of that happening in states where you're not as close to a body of water like that, i.e., the Midwest. So yeah, I mean that in addition to like Florida was just a hotbed during COVID of people just mass migration, right? A lot of folks from the Northeast, a lot of folks from California, because Florida was one of the states that was open. So you know properties are trading at these incredibly high prices. So you're dealing with that. So there's just kind of a mixture of things. And again, that's very difficult coming from when you're just rocking and rolling in your target market to having to go and compete with all these people. You're talking to sellers and they're laughing you out of the room because it's like, oh yeah, I've got 10 offers and it's 20% above what I'm asking. And so it's just that, to me, I felt like I was spinning my wheels, and felt like my time was better used elsewhere.
100%. No,
So I don't
100%.
know if you felt that way, because especially when you're going
Yeah.
direct to seller, like they have to want to transact, right?
Yeah.
And so if they're just fishing, then you're kicking the tires.
For sure.
So
And we did, as you know, we were involved in a few deals in Florida. We sold
yeah,
two. We still have one down
and
there
Lakeland, right?
in Lakeland. Yeah.
Okay, yeah,
And we still own one that's in a town that kind of borders Lakeland, a small town, but
okay,
Central Florida, right? It's not on the coast, which is a different ballgame. I mean, we still got, hammered with insurance increases
sure,
as because carriers are just leaving the state, broadly speaking. But
right,
we don't necessarily have the same kind of flood risk, right? We don't have flood insurance because we don't need it, right? We're not in a flood zone,
yep,
but that's an entirely different dynamic to manage as well. But
yep,
echoing what you're talking about on the direct to seller side, because obviously we do a ton of direct to seller in New Hampshire and we do a lot of deals in New Hampshire, but like we're still doing some in like the Central Florida area where we have a building and where we have owned in the past. But like we're also in this weird limbo from a distress standpoint. Like, we sold a couple buildings to a group. I don't, whatever. I'll just vaguely say it. Like they probably paid a little bit too much. We got out at the right time.
sure,
They probably couldn't exit those properties at the same price right now. And sellers like that, I think there's just more of an interest in holding on longer term and just riding it all the way out versus like
yep,
taking a short term haircut. Because I think people do kind of believe that it's going to get a little bit better on the insurance side and then on the rate side. So it's weird in that, yeah, it still kind of comes back to the same seller profile that we're looking for, which is like the person who's owned it for 15, 20 years that's like trying to retire, which is not necessarily tied to the economics of the property. Um, but anyways, let's talk about what you are doing to find deals because I think that's what people are really interested in here. And
sure,
I think maybe providing some context around, doesn't have to be exact stats, but like number of
sure,
deals or units that you currently own in the Midwest to give kind of people of a sense
hmm
of like what you got going on. But then let's talk about what you're doing nowadays. I know you're mailing mailboxes, right? That's your special sauce. But
Yeah,
but
that's
outside of
correct.
that, what does your acquisition strategy look like from a direct to seller standpoint?
So, I've got like a few different buckets, if you will. We've, we were running and gunning pretty heavy on the single family and even small multifamily there for a little while. So I was doing a lot of mailers. At one point, we were doing, I don't know, maybe. I mean, again, I'm pretty hyper focused on a few tertiary markets in Indiana. So we're doing a few thousand mailers a month, which honestly isn't a lot. We had that mailing campaign set up with a call center. Inbound calls come in, and then we have an acquisition manager, almost similar to like a wholesale shop, if you will.
Yeah.
But some of those leads on the small multifamily would come through there. So a little bit of a mailing campaign, and then I'm very targeted with cold calling. I don't have a ton of cold callers. We have one that works for us, but it is like your grassroots mail cold call. I would when I'm like trying to teach new people or folks are talking about maybe coming into our ecosystem, I try to describe it like we don't want to have like an army, right, of like 10,000 people that we're just hounding people. You want to be more, or I would describe this more as like a sniper, right? It's hey, we're pretty targeted, a little more lean, but making when we're having these conversations, not, hey, you need to go make 10,000 cold calls today. It's, hey, you need to have, five good conversations with somebody that, hey, they may not want to sell exactly today, but it's, hey, we're having a quality conversation. Let's get, something going here that starts to move the wheels a little bit. So that's in short, I guess, what it is. Obviously people on social media see the mailboxes and things like that. Again, another very targeted kind of sniper like approach is, hey, I've had conversation with this people. There's been follow up, and then that's what I'll usually write a note in reference to our conversation. They get a huge box like, what the hell is this at my front door? And then it's like, oh, I've talked to this guy. I need to call him, right?
Yeah.
So that's like I said, very. I think from the outside looking in, I think people would probably say, "Man, he must have all these like crazy marketing schemes, like this, secret sauce." That's absolutely not the case. When you really peel back the layers, I would describe it as like it's pretty simple.
Yeah. How does the
But
conversation change for you or the approach change? Because you mentioned marketing to single family as well and also
sure,
small multifamily.
sure,
I'll define maybe like
sure.
5 to 20 units, 5 to 30 units, whatever we
Yep.
want to assign for that kind of segment of the multifamily space. Is it still the same marketing, same language? Or is there a different approach in the two kind of brackets?
Sorry about that. I don't know what's going on.
No worries. Yeah,
No.
whatever. Go ahead.
So to go off, yeah, your question about difference in language versus like single family or multifamily. That verbiage in those mailers or even on the calls is somewhat similar. The one-off single family homes, no, it's a much different conversation. There's typically not as much sophistication. So if we're getting those people on the phone, we try to relay to them very quickly that we've got sophistication. We own some other properties in that area, and it's not just casting such a wide net.
Mhm. Yeah, and so I guess in general too. So from an acquisition standpoint, right? I mean, I know you've done some bigger stuff, right? I think and correct me if I'm wrong, but
Yep,
you took down it was like a big portfolio. Was that last year before? It was like 60, 70 units, something like that. Um,
yep,
am I remembering that right? Gotcha. So, obviously you're doing a lot of deals. I'm sure you're just buying yourself, right? The small family office, and then you have, maybe a deal like that. It's a little bit bigger. I'm assuming maybe you had an investor handful or however you structured that one. Like, what is typically the
yep.
objective in doing deals? Are you trying to buy them all solo, do them yourself? Are you going out there and bringing in JV partners when you have to?
Sure.
Is it kind of deal dependent? Like, all right, and I guess it's two
Yeah,
questions. What is the objective and what you're
sure,
trying to build from a business? And then,
sure.
when you get your hands on something larger, how do you typically handle that?
Yeah, so I mean, it is deal specific, right? Like I try to keep really just taking these deals down myself. There are times when it's like, hey, I'm short on cash. I need some gap funding. That's typically when I'll bring private money in. It becomes very difficult to have private money on some of these deals where there's a little longer time horizon because I'm paying. If I'm not giving up equity, well then I'm paying more on the interest rate. So those deals you have to have a pretty low cost basis, and there has to be some good meat on the bone there for those to work. But the objective of whether it be a portfolio of single family homes, some small apartments, self storage facilities is I'm looking at, hey, how do I build out almost like a moat for myself? As crazy as that sounds, right? But kind of creating these different assets for myself that I can pull the levers of, hey, okay, as I buy these portfolios of single family homes or whatever the asset might be, I can leverage those to trade up. So instead of going out and maybe buying an 80 unit or 150 unit as a syndication, I'm buying the 20 unit, or I'm buying the 30 unit on my own, right? I'm buying it with one partner. Or hey, we're flipping houses and we're moving that money into some bigger assets. That's kind of the approach right now as I acquire more stuff, is to continue to really have velocity on the money and then step up in those asset classes. So, when I first started, I was buying D class single family homes, D class properties. That has since, migrated more towards, B class, and even really trying to pick up some A class stuff as well. So
Gotcha.
that's in short, that's like the progression for me.
Hmm.
Even as we could go and continue to pay more for these properties, that's, hey, that's just what I want to do.
How many units are you up to now? Or I mean, I know you have some
Yeah,
storage, you got
yeah,
some
yeah,
commercial, but talk about
yeah. So
just
I
the
mean,
size of the portfolio.
yeah. So we've got, we talked to, and this is much different in the storage world, like, because it's square footage wise.
Yeah.
But we've got 7 active storage facilities right now, 2 down in Texas, 5 in Indiana, and then I'm closing on another 2 next month. So I'll take us, excuse me, to 9 total storage facilities. And then we've got on the residential side of things, like residential units, we're pushing a couple hundred units on just like single family houses and small apartments. Our biggest apartment deal is a 19 unit. And then, yeah, you were right. Like a year or two ago, we picked up another like 53 units across 35 properties. So we've
Wow.
got a few hundred going on the storage, apartments, single family. But there's no syndication. It's either I own on my own or with one other partner. And then some of the stuff down in Texas are joint venture opportunities.
Nice. Now, kind of a
So
tactical question, right? Because I think a lot of people
sure.
listening to this invest outside of where they live, right? Or they want to start
Yep.
marketing in a market that they're not physically present in. Like,
Okay.
how do you manage that dynamic, right? I guess that's the broad question, but you're sending all of this mail and doing all of this marketing, you're calling in Indiana, you're in Florida. You
Yep.
can't go, hey, come check out the property this afternoon. Like that's not reasonable, right? How do you like
Yeah.
what does the funnel typically look like there in terms of like, getting comfortable putting something under contract? Do you send somebody out there once it's under contract to do an inspection? Like what does all that look like?
Well, I mean, that's the advantage of being super targeted, right? Is like the more that you transact, the better, you feel about the area. And then,
Yeah.
you feel more confident in being able to move quickly and effectively. And so, prior to moving to Texas, moving to Florida, I was in Indiana and I was walking those properties, I was running those markets, and just I was the boots on the ground. So I spent a number doing that before I had the ability to actually move. But yeah, now today, if we get contacted with a seller and they're expressing interest that they want to, they're ready to move, then yeah, we'll typically send somebody out, do a walk, but verifying that there is motivation, that they're wanting to play ball with us. On like our residential side of things, we have third party in place, but on the storage, we're vertically integrated. I say that with air quotes because
Hmm.
we're still, it's a work in progress, but um, each asset's a little bit different, right? There's not a one size fits all in terms of the management. But that's why I'm sort of, kind of migrating more towards more of the storage, as it's easier to manage. It's less friction, I guess I would say, with the day-to-day management. So yeah, we're fortunate because again, we have a third party in place there, but I also have a partner who lives in Indiana. And so we try to have some of that omnipresence, if you will, of like, hey, we'll come down, we'll take a look at the deal. Back if I need to fly in, we need to go walk a deal, then I'll certainly do that as well.
Yeah, exactly. I mean, there's probably a size threshold, right? In terms of where you're like, yeah, it's worth me taking a trip back. It's like if you're doing a bigger one,
Correct.
that's, single family
Correct.
home, maybe not. But if you're, that 19 unit, right, for example, or that big portfolio or whatever it is, like you're probably going to get
Yep.
back and
Yep.
and walk it. Now, the last time you were on, and I mentioned this to you before we started recording, I think I included in the
Yeah.
episode title "Buying Properties for $1," and I think I probably got a lot of clicks on that one with a title like that. But you're always throwing up on Instagram too, whatever it is, like $100 or some. There's ridiculous numbers that are on these closing statements, and you're
Yeah.
obviously operating in a lower cost market, right? Than I think most
Correct.
people are.
Correct.
Tertiary markets in Indiana, right? You can buy homes for whatever it is, 50, 70 grand or 100 grand or whatever the
Yeah.
stabilized value is for some of these. But like, do you have any good stories? I guess any recent stories that come to mind? Last time we were on the show was like a year ago, I think. So there's,
Sure.
but uh, but anything that comes to mind is like, wow, that was a doozy.
Um, this one was more so a this is a commercial deal, and it wasn't like a crazy. I mean, we did well, I think, in terms of like the acquisition price, but um, this person, I think, like you ever see like those screenshots on Instagram of like like a guy or a girl like just hounding someone else they're like trying to date or like pursue, right? And it's just like all green bubbles. That was me and a seller for. I mean, I had a text for probably like 2 years, 3 years, and it's like just it's just me hounding them, right? And it's like I'm on iPhone. This isn't like a CRM, and so I ended up, they gave me the time of day and ended up selling. And it was just funny because I never, and maybe this is something for the listeners to take away, but when I'm interacting with sellers, there's people that tell you to go F off, right? There's people that are like, I'm not interested. So every time that you're interacting with somebody, you're trying to gauge that interest. And these people never really gave me like a, hey, go, pound salt kind of deal, but it was not, there just never really seemed to be a high level of interest. But it was a property that was, would just be plugged in with some of the other ones that are in my area. And it really made sense. And so it was just, I stayed after, I stayed after, I stayed after. Again, I think it was like 2.5, maybe 3 years of just consistent follow up. And finally, those people were like, yeah, we're ready to go. Took over the property. It was just an absolute nightmare. Like they weren't collecting payments. This is a storage facility. And, a lot of the folks that we talked to were just like, wow, we can't believe that you guys are even reaching out. We've had a unit here for, however many years, we just haven't paid. So it was funny because of like how like for how long I pursued that deal to just not know that that was going on. And, again, like in some of these, and I hope, and I would imagine you could probably relate to this, like sometimes sellers aren't keeping the best records, right? And so they just give you very limited information. And if you're super niche down to that area, it's sometimes you can get away with that and just kind of rent for a not so much in the sense of, hey, this guy's got to write this stuff in stone. I know that like when I take it over and I operate it, I can get this thing humming along. But yeah, it was interesting, like seeing the time invested with that follow up. I would say it's probably not as exciting as like buying a property for $1 or $10, but yeah, like those, I showed a few people those that, that's the text exchange, or I shouldn't say the exchange, it's me, hounding this person. But again, that's like some of the art, right? Like you don't want to get super annoying, but consistency and things like that, come into play. And so it was nice to see that come to fruition.
Well, I mean, there is a takeaway there, right? In terms of like, if we're trying to take something from this story and apply it, like sometimes it takes 2 years worth of follow up, regardless of what you perceive the level of interest to be. And we have plenty of versions of that
Correct.
story where, um,
Yep.
like as you mentioned, right, those like memes on Instagram where it's like some guy texting some girl happy birthday every year for like 5 years, just waiting for the response. Like I've
Hey,
done that with
hey.
sellers, yeah, and it's just, and it's every 6 months, any change in your, and some of those have turned into deals,
Yeah.
or at least
Yeah.
turned into productive conversations, right? Which is
Yeah.
all you could ask for, and something that again, if I were to make this into something tactical for everybody, um, it's less about convincing a seller to sell and more about being top of mind when they do decide to sell, because you're never really going to be like, a guy's not going to go from not wanting to sell and you're going to convince him. Like that's just not going to happen.
Right.
So
Correct.
it's more about being present and being in front of somebody frequently throughout the whole course of their ownership, so that when they do actually decide to sell for some third, or I should say external reason, they're giving you a call, right? Which is obviously
Absolutely.
what you just described. But yeah, and then on the record side, I think I speak with a lot of people who want to do direct to seller and they're like, I can't get a T12 out of like the seller. And I'm like, well, you're just not really ready to do deals direct to seller if you need
Yeah,
T12s and you need tax returns and you need all of that. Like the whole reason that we're going direct to sellers is to find the sellers that can't do that, which is why they are then willing to sell at a discount because they know that they don't have what they need to go and put it on the market, right? So you're self-selecting
correct,
for those types of
correct.
opportunities. Um, and I guess
Yeah, and
just a
that's
quick, yeah, go for
yeah,
it.
and that's why you're not paying, market price more times than not, right? Is because you're taking bigger risk. And I was hesitant to say this, but it's the absolute truth. I bought properties with no financials.
Yeah.
Like it's that sounds terrible, and people, maybe I wouldn't advise that for your first one if that's what you're getting into. But on some of these, when you've got a few deals under your belt and you're in a market where you know how things operate, you're confident, you've got a good lender behind you, you've got you've got traction. Again, if someone's not, like in a few of these instances, some of these sellers are running other businesses. This real estate is not their primary source of income, and so their bookkeeping might be a mess, their operation might be a mess. That's opportunity for guys like you and myself and other people that can come in there and effectively operate that and capitalize on running it more efficiently. So
Hmm.
that's just I found a lot of value in some of those opportunities. You're not going to see those on a more times than not. You're probably not going to get that on a 150 unit deal, a 200 unit deal. Like there's more sophistication there, and that's the nature of like the like space that we're playing in a small multifamily, small commercial.
Yeah. And I think part of the challenge too is people talk about multifamily with like, they just use the one word, where in reality, 100 plus unit or I would say where you start getting people on site for management, that's a different asset class than the scattered site
Correct.
5, 10,
Correct.
15, 30 unit buildings. That's they're not even really the same asset class because of the fact that
Not at all.
100 plus unit deals, even if you're in a weird market like a tertiary market that's not got a lot of population, like that's a pretty efficient marketplace, in terms of how those deals are underwritten, in terms of how debt is put together on them, in terms of strategy
Yep.
and operations from an asset
Yep.
management standpoint. It's pretty efficient. You're underwriting the decimal points there, whereas a 10 unit deal, like you can go buy a deal. We just did a deal that's 15 units in size. It's not a big deal. It's, we paid 1.4, but current market value, if we were to go relist the two buildings, it's an 8 unit and a 7 unit, we'd be able to list it for probably around 1.9, $2 million. The only reason that we were able to buy that deal was because the seller is just completely out of the woodshed and just we got into one unit in both of the buildings during our inspection, right? And most people are like, you got to walk every unit during your diligence. And it's like, yes, you probably should if you're raising capital, if you're doing a big deal, if you're underwriting to
Sure.
exact capex figures. But I'm like, we're
Sure.
buying this at 90 a door and it's worth 115, 120 a door. All of those units could be disgusting and gutted. And I'm like, that's fine. Like, that's okay.
Yep.
And I don't even, the rent roll is probably inaccurate, but there's so much margin from a price standpoint, that you can accept that level of risk. And as you mentioned, right, the asterisk is like, you don't want to do that for your first one. Probably, you probably want to get your
Sure.
feet under you,
Sure.
but like, but that's the opportunity that going direct to seller provides. But it comes with, you need to be willing to accept a little bit more risk. Um,
No, you're
now,
100% right. And then
yeah,
in addition, sorry, but like having that mentality then allows you to move quicker to give the seller more confidence, right? Because if you're like, well, if you're giving them any sort of indication that you're not confident in being able to move quickly and effectively, like there's a lower likelihood you can get that thing done, or a lower likelihood of another person bringing you that deal. Because I think that that's kind of a way you source a number of your deals is
yeah,
organic,
just the
right? I mean,
referrals. Yeah.
yeah, because people know that you can perform.
Exactly. Yeah, we have an agent who we did two deals with, who I met, maybe a year ago, but we finally
Sure,
started doing deals. And he does a lot of kind of direct to seller. He's putting deals together off market. He's a
sure,
hustler, and we've done two in the last like I don't know, maybe 3 months, 4 months,
okay,
and
okay,
both decent sized deals, over $1 million in size, both of them, and they were both pretty hairy deals, right? Hairy in the sense that the seller had incomplete financials or no
okay,
financials. I'm not, I don't even, incomplete's the wrong word here. We're not receiving trailing financials, right? We get a rent roll, one of them on paper, handwritten with a handwritten signature at the bottom, and the
those are
other
the best
one,
ones.
yeah, those are the best ones, from a management company who stopped managing the property a year ago, and the seller just I don't know. Like they're sending me checks. Like we don't know who's in the units. We don't know the size of the units, and we don't know what their security
Okay.
deposits are. So like very hairy deals where we couldn't really get through all of them during due diligence. No financing contingencies because the seller
Sure.
wouldn't allow them. All of those different things, and we got them both closed. And it's like if you do a couple of those, whether it's with an agent or like a wholesaler or an investor refers you over something like that,
Yep.
you build so much credibility and goodwill because especially nowadays, like a lot of people just can't really do that. Or there's a
You're
real level
100%
of
right.
discomfort with doing deals
Yep.
like that. But I want to ask you this too. So
Sure.
you're doing deals in smaller towns, smaller cities, tertiary
Yep.
markets. You're getting
Yep.
in private money on a lot of these on the buy
Yep.
side. You're optimizing the rent roll. You're doing the whole value add thing.
Correct.
Like,
Yep.
what's your takeout on a lot of these? Are you working with local banks, local credit unions
Yes.
to put? Yeah.
Yes.
So, and that's
Yep. I mean, we
probably
got,
the only option you really have for stabilized debt, right?
yeah, I mean, because we're not dealing with, these aren't, the portfolio deal we did was a little over $2 million. We got a couple in play right now, decent sized deals, right? For like bounce around the $1 million range. But it's a perfect fit for like a local community bank. And we've built some relationships with folks that, it's just the lending side of things is, I feel like some of our, like it's a strong suit, kind of a nice thing that we have because we've built such a good relationship with a few of these lenders, both private and local banks that, hey, when a deal comes up, they're like, you guys typically do very well on these, and we'd be happy to partner with you on the lending side. And so that makes my life a lot easier, as opposed to having to come in cash on everything, right? Because it's
Yeah.
trickier to try to go raise the cash, and then again, there's just got to be more meat on the bone for those deals when you're bringing private money in versus, hey, if you come in and do a traditional bank note, you put 20-25% down, and those banks are still able to move quickly. It certainly helps with, getting those deals across the finish line. But yeah, we've been very fortunate with our banking relationships. It's always a good feeling when they like, get an email or a call from the banker. He's like, man, you guys are pretty good at these cold calls.
Yeah, yeah.
So,
Yeah, for
uh,
sure, man.
you know,
That's how we're finding them all. But so I mean, the other question too, you got a bunch of single families. So, a lot of
yep,
people don't, single family, you add your value, you get out of them, and it's not necessarily the
yeah,
highest cash on cash returns. And your market's a little bit
yep,
different in terms of the pricing, right?
yeah,
Versus like for me in New Hampshire, where like median home values are like 450K, you can
yeah,
rent
that's
for,
nuts.
and it's just not gonna, you're not gonna do those types of deals.
Sure,
Um, is there a reason you elect to hold a lot of single families versus turning that cash and bringing money
sure.
into the building, into the business a little bit more quickly?
Yeah, I mean,
What's the thought
some of it,
process?
some of it is, I almost look at it as just like there's some cash sitting there, and to my point earlier, being able to pull those levers, right? There was a storage deal we did not too long ago where I really didn't want to bring any outside money, so I had a few $100,000 cash, and I'm like, man, I'm short another 200. So we sold off a single family house and we refied another one or two. So again, just kind of leveraging those things as different levers to pull when we need cash. They're liquid, I would say, right? Hey, you can
Yeah,
go sell off a single family home in a few weeks. So that's why, a couple of those I hold them in cash. And with some of the volume that we're doing, we do come across some good opportunities where it's like, hey, we should just hold on to this thing, right? As opposed to, hey, let's go wholesale, or hey, let's go do a quick flip on it. And, you make 25, 30, 40 grand. Well, by this time you pay your capital gain, all that. It's just like, hey,
yeah,
we may not need that cash right this moment. But hey, if we could go maybe refi that in a year or two, if we need that cash, so be it. I will say that the downside to those single family homes is, when you're buying homes that are, they're renting for 6 to maybe $1,000 a month. If you have a large repair item for the year, that pretty much annihilates your cash flow, right?
yeah.
So if you have debt on those properties, it really becomes troublesome to actually to get cash flow from those things. But again, I look at them more as like just things that I can move around to store cash, and use when necessary. I don't know if that sounds crazy or not, but that's how I've kind of used them. So
Well,
again, similar description as like a springboard into different asset classes. Like, if I had the opportunity to go buy an A class property, there's some sort of competitive advantage, whether it's distressed with the seller or some sort of deal, I would look at, hey, well, let's go move some of this money. And instead of having either go do a syndication or try to get, more creative with the private money, I'm just trying to build up that war chest, if you will.
Yeah, I also think too, I mean, if you're an investor who has like one or three single family homes and that's your entire portfolio, like there's a lot
Yeah,
of variance in running something like that. Whereas obviously now you have a number of units to where the variance is kind of smoothed out. Like it's a little bit easier to handle those one-off, like the water heater went, it's going to kind of kill my cash flow here for 6 months, but that's fine because I own a large
right.
portfolio and amortize over the whole portfolio. It's less of a hit. But and I also know a guy too who, he buys a lot of single families in New Hampshire. He flips them, I shouldn't say he flips them. He renovates them with the intention of flipping them, but he puts a tenant in for a year post renovation, and then he
Okay,
sells in a year, and either 1031s or
sure.
now he's in long term cap gains. And he's like, it's a little bit more tax advantaged. It doesn't necessarily make sense from a cash flow standpoint if I'm thinking about where else I can put that money, but
Correct.
tax wise, it makes more sense. Which is again is a whole nother conversation
Yep.
probably for a different podcast, but when you have a lot of them condensed in a singular market as well, it's probably a little bit easier to handle that, and you can get
Yep.
out of them too, I would imagine. Like if you sell a
You
single
can.
family, are you
Yeah.
primarily selling them to homeowners or to other buy and hold investors?
Yes. No. Just prep. I mean,
Homeowners.
because you get, yeah, your highest and best out of typically
Yeah.
homeowners. So if we have a tenant that, is scheduled to come out, or they've not renewed, and there's an opportunity for us to cash in on that. Sometimes if we need the liquidity, yeah, we'll do that. But very rarely will we sell to other investors. It's just, that's not my
They're not
preference.
the ones paying the most. Yeah, exactly.
No. I
Um,
sold like a lot of my stuff in Indianapolis, um, like the metro area, like kind of closer to downtown. I sold a few of those to other investors, but I was kind of ready to get out of like you know the downtown area, if you will. So, but yeah, primarily owner occupants.
cool. All right, my
Yeah,
last one, then we'll get you out of here. What is
no, you're fine.
like what's your goal in terms of what you want to build here? And the reason I ask, a lot of people they start doing deals themselves and then they eventually want to go and
Yep,
syndicate and do big deals. I think that's what everyone assumes is kind of the path that most
sure.
people want to take. Um, you've kind of defined that that's
Yep.
not necessarily where you want to go, but like what, build a big portfolio in Indiana and live in Florida and hang out. Like what's the end game for you?
I mean, like when I first started doing some like, trying to get into real estate, and whether it was just working as an agent or, starting to pick up a few properties, my main thing was, hey, I want to, I want to have complete control over my time and my location. Right. And the nature of our business is like, it's heavily involved with people. Right. So it's tough to just go fall off the face of the earth for, 6 months at a time if you're trying to grow a business. But for me, and what I'm doing on a day to day is like I said earlier, like I want to create this like fortress or this moat, if you will, of properties that can help create like a very predictable way for me to have cash, to have equity, to grow wealth. It doesn't need to be a thing of where I'm seeing these crazy returns overnight, but it's something for me that I'm confident that I'll continue to build. And so the goal there with these small commercial properties and single families and things like that is to trade up areas where it's prime location, right? It's something that is more of a generational wealth play, right? If it's like, hey, we're building something here that's not just for me. And so that's what I'm looking at is, hey, with some of these storage assets, with these multifamily assets, how can I pull these levers to continue to trade up? And so I've got some like, goals as far as, hey, number of properties. And I shouldn't say like door count anymore, but more so number of properties, net cash flow, things of that nature. My goal this year is to go out and pick up 20 storage facilities. So we're really hammering, the storage side of things. But yeah, I mean, I guess in short, I'm not super specific, or maybe I should be on, hey, I need, X amount, but that's what I'm working towards is, continued complete control of my time and my location.
Yeah. Oh, I mean, you kind of nailed it, right? Where it's like, I think the big thing that people have to define is, well, one, define the lifestyle that you want, and then two, you have to determine whether or not you want to be an invest, an investment shop where you're raising money, because that's an entirely different game to be in than just being a dude who goes out and builds a portfolio of real estate, who's the one calling all the
Yeah.
shots and maybe has a partner or two that are casual. Like those are just two
Correct.
completely different roads
Correct.
to go down, and you've defined which one. So that's, that's great. We'll have to talk about the desire to buy a bunch of self storage, maybe at another time. But it's an
Sure.
interesting
Sure.
pivot. I mean, actually, let me ask you, like, before we get out of here,
Yeah. No.
what is
Sure.
the is there a reason that you want to pivot to storage versus spending more time on the residential side? Or is it
You
just like
know,
you're seeing opportunity direct to seller there, and it's easier to kind of build that deal flow?
I would say more from an operation standpoint. I'm seeing. I don't know if I shared this. I mean, it's been a little while since we talked, but I tried to start a property management company when I first started out, and I had a handful of single family homes. I think had bought my first 10 unit, and I failed miserably. I mean, the property management, as you know, is not it's not a glamorous business, right?
Yeah,
It's
it's just
like
you wake up every day, you get
first,
kicked in the nuts, and then you go to
yeah,
bed and
first,
you do it again. Yep.
correct. It's like first one to get yelled at, last one to get paid type situation. And as I looked at, moving into other markets and growing multifamily, growing single family, portfolios, the management of these assets is so important, right? Like you can live and die by your management. And so when I had a kind of an off chance to buy for the first storage facility, I had no idea what was going on, right? But I knew there was a good cost basis and got in there, rolled up the sleeves. And as I started to learn more, I realized, wow, I can be very effective with the management of this asset. And so that's very attractive to me that I can plug these assets into our ecosystem, and not have to have as I would say, like, hands-on management like you would with a single family or an apartment building. And so that's why it's very attractive to me. Yes, there's certainly a number of direct to seller opportunities there. But I think if you apply enough pressure, enough time to the asset class that you're looking into, the direct to seller opportunities, like you'll find more of those, right? I just happened to kind of fall into that. And I just used what I was already doing with the single family and multifamily acquisition in storage. But again, I would say more than anything, it's the operation of that thing, that I can do it in house and I can have control, because you get a really, and you can probably attest to this, you get a better pulse of how the properties are operating. You're not having to, like, pester the property management company and, hey, like, did we get this unit leased? And hey, are we renewing leases at new target rents? Like you've got a little more control on that. So that's primarily, I would say, a driver there. But most people, oh man, you got a handful of self storage facilities. I'd love to get in storage. You have to have so much square footage there to
Yeah.
equate to even a fraction of the revenue that's generated from even an 8 unit, a 10 unit apartment building. It's a different play.
Yeah, I mean, like I could just go down the rabbit hole with property management, but like it's just if you don't have that figured out very well, especially if you're doing deals not in a non-major area, like you're talking about doing deals in
Yes.
tertiary cities and small cities, like for us, Southern New Hampshire is still an hour from Boston, right? I mean, it's still
Yeah.
like a decently populated area, and we're also like the main city that we invest in still has 135,000 people that live in it. And so
Sure.
there is infrastructure. So there's plenty of third party options. We brought it in house because we wanted that control and for all the reasons you just mentioned. But like, especially so if you're doing deals in an area that 20, 30,000 people, maybe you got a few management companies, like you really need a good management partner if you're going to be outsourcing that. If not, you got to bring it in house. But then that
Correct.
introduces all of
Correct.
the pain. But that's also why, and then we go back to the other side, why that market's inefficient and why there's deals to be found is because people aren't great at the management stuff. And there's not a lot
You're
of options
100%
there.
right.
So yeah, it's like if you get a lot of square
Yeah.
footage of storage in a condensed area and you can run that, in-house and you have control over that, like that's probably an easier management challenge to solve for than having a bunch of scattered sites, smaller buildings kind of spread throughout a bunch of small towns and cities. That would be my guess, but because I'm not in there.
Yeah. I
But
mean, like a month and a half ago, 2 months ago, we had a sewer collapse at a property, and it's just like, this is a single family
yeah,
home, and it's just like there's just more kicks in the nuts, right? It's like, okay,
yeah,
if I move a little bit to the left, does it hurt as bad, or does it, like,
yeah,
you know?
yeah,
So
yeah, exactly.
like that's kind of the natural progression. And
Yeah,
yeah, I mean, don't be wrong. There's people that great success stories on multifamily, single family, going to those portfolios, and I will continue to do so. But just I haven't had the I guess inclination just yet to go start that management arm, and so maybe at some
Yeah.
point, I'm not sure.
Yeah, when you hit a scale to where you can kind of overhire and it's not a frat, like where you have
Yeah,
multiple
sure.
PMs, a leasing agent, and you have staff and infrastructure in the business. That's kind of the only way to
Yep.
do it. I mean, that's the lesson we
Yep.
learned. But yeah, man. I mean, last week we had a guy shitting on the back porch because his bathroom didn't work, and he just said, "I'll just go outside on the porch instead of calling you guys to
That's
come fix
good.
my
That's
toilet."
pretty.
You don't get that in self storage. But hey, maybe it's less fun too. There's a
We
spin
get
zone.
people living in there.
Yeah, there you go.
We get
That's your version of it. Yeah, is
yeah, we get some people. Yeah,
some occupancy situations. Yeah.
it's
But
yeah, yeah. No, we're full. We're full here.
yeah. Yeah, exactly. All right, man, I'll get you out of here. This has been great. I think people are probably going to take some stuff away on the direct to seller side and thinking about how to actually approach that part of the business, which is always great. If folks want to reach out to you, learn
Well,
more
hey,
about you,
I
where
appreciate
can they
that.
do so?
Yeah, give me a shout on Instagram. I'm just Zach.Hoereth.
Easy enough.
So
I'll link that in the show notes too
not
for
too
everybody.
crazy.
Yeah, yeah, exactly.
Um, sorry about the Wi-Fi connection here. You're in a nice Airbnb, but I guess that doesn't come with sold separately.
Yeah, you're gonna have to give me the listing. I'm gonna have to leave a 2-star review and blow up their entire business here, an act of vengeance. No, it
That
held
would
up
be
pretty good
good.
throughout. Yeah, couple of spots we'll edit in, but
Very good.
yeah, but no big deal at all. All right, man. We'll enjoy Scottsdale and
Good.
we'll chat soon.
All right, man. Yeah, let's catch up. I appreciate it, Axel. Thanks so much.